Is Trump using the Treasury to build a $1 trillion plus bazooka that he plans to launch into the stock market, creating a supersized bubble right before the election? Well, stick around. Let's look at the data. Let's look at what's been happening with something called the Treasury General Account. And I think you'll be convinced that the possibilities this will happen are more likely than not. Let's dive in. What's up, everybody? My name is Joe Brown. This is Heresy Financial, and on this channel we talk about financial topics that you will not hear on mainstream financial news, information that can help you make better investing decisions, such as the president might be building a giant war chest, a bazooka, that he can launch into the stock market, sending it up to all-time crazy astronomical highs right before the election. Now, huge shout out. Many of you watch George Gammon and his channel. He always has fantastic information. I'm going to link a video in the description below that he put out recently. His video is extremely detailed, thorough, and in-depth. And so if you like the content here, definitely go check out that video because he goes more in depth into what I'm going to talk about today. Let's do a little bit of a banking system 101 here. Right now in America, you have the banking system, and when I buy something from a store, that money leaves my bank account and goes into the bank account of Walmart or Target or Amazon. Everybody's got their bank accounts. And so when all of the transactions and commerce is happening, all that's doing is swapping the bank accounts that all this money is in. Now, after those transactions all take place, there's not been any additional growth of actual money in the system. The total amount of money in the system stays the same. Now, all of that money then at the bank accounts is held with the Federal Reserve in reserves. So commercial transactions, retail transactions, buying and selling doesn't grow the amount of money in the system. So how does the amount of money in the system actually grow? Well, it grows one of two ways. One way that it grows is foreign countries, foreign actors, lending money to the United States Treasury. They buy a Treasury bond. They loan money to our government. That takes foreign money and plugs it into our system, because what does the government do with money that it borrows? It spends it into our economy. And so when our government borrows money from overseas, issues treasuries, and those treasuries are bought by foreign central banks in other countries, that money comes into our system and grows the amount of money in our banking system. Now, this is clearly not the only way the United States government gets the money it needs to spend. They also receive income from taxes. They also borrow money from U.S. citizens. But even all those three put together is not enough to cover everything that the government spends. And so in order to make up the shortfall, after borrowing from foreign actors, after borrowing from its own citizens, and after taking in income from tax revenue, it still needs to make up a shortfall, which it does via the Federal Reserve. Now, the Federal Reserve prints money, and they print money and buy treasuries. So they're basically creating money out of thin air to loan to the government. Now, it goes through the banking system first. It goes through the primary dealers. They're not buying this treasury debt directly from the treasury due to a legal stopgap there. But essentially, right now, the Federal Reserve monetizes debt by printing money to buy United States Treasury debt. So those are the two ways that the money system grows. The Federal Reserve prints money and buys U.S. government debt with it. And number two, the United States government borrows money from overseas, and that money gets spent into the United States economy. Now, there are some of you right now that are saying, wait, the fractional reserve banking system means that banks themselves can increase the money supply because they can lend in excess of the amount of reserves that they have. Yes, that is true, but that is a credit cycle that goes up and down because eventually that has to contract again. That debt is repaid. It's not something like treasury debt that continuously and constantly gets rolled over. And so because of that, we're not going to look at that for this example because it doesn't have any impact on the conversation that we're having today. So that's banking 101. We have the banking system, transactions take place, but no growth of money actually happens. It's the same money, just swapping hands. The way the money supply grows is money coming in from overseas or money being printed by the Federal Reserve, and that both gets funneled through the Treasury. The Treasury issues debt, they borrow money from those two sources, and when they borrow money, they spend that into the United States economy. Now let's take a little bit of a road trip back in time. We're going to look at pre-2008 because something changed in 2008 during the Great Financial Crisis. So pre-2008, the Treasury, when the Treasury would spend money, they're spending money into the economy. Well, who gets the money that the Treasury, that the government spends? Well, it goes to government employees, it goes to government contractors, it goes to businesses that are contracted with the government to supply services, like military companies supplying arms and ammunition to the military, healthcare companies, all sorts of, everywhere the government spends money, it's essentially just people and businesses in America. Well, what happens when people and businesses in America get money? Well, it goes into their bank accounts, right? Because that's what you do with your money, it goes into your bank accounts. Remember earlier when we talked about Banking 101, what all the bank accounts do with deposits? Well, they're held at reserves at the Federal Reserve. Okay, why are we talking so much about reserves? Hang in here with me. Prior to 2008, the Treasury held its account in the commercial banking system. This means that when the Treasury spent money, it was leaving one bank account and going into another bank account of a person or a business. And so the total amount of the money in the system is not changing prior to 2008 whenever the Treasury spends money, whenever the government spends money. It's just leaving one bank account in the commercial banking system and going to another bank account in the commercial banking system. All the bank deposits in the commercial banking system are held on reserve at the Federal Reserve. This means prior to 2008, every dollar that the Treasury spends into the economy is not growing or shrinking the total money supply. It's just changing the bank account that it's in. Now, because of this system, take a look at this chart. This goes back to 1988, and we can see here the Treasury General Account usually fluctuated between $2 and $5 billion. That means whenever the Treasury got money in from either borrowing money or receiving money through taxes, they spent it. It was a money in, money out situation between $2 and $5 billion pretty much. All right, let's fast forward now to the financial crisis, the Great Financial Crisis. You had all of the banks loaded up on really bad investments that were leveraged and toxic. They were just imploding on themselves and they were all about to fail. So the Treasury and the Federal Reserve were talking to each other and they're like, look, we need to do something about this because we don't want the banks to fail. So we need a way to let the banks unload all of these toxic assets. So the Federal Reserve said, all right, well, we will just buy these toxic assets from the banks. And that way they give us these toxic assets. We'll buy them basically at full price so they don't have to take the losses on these assets. And then they get the new cash that we just printed out of thin air. Perfect. That way they don't have to take these losses. And then the Treasury says, but wait. If you do that, the Federal Reserve prints money, gives it to all these banks, and the banks unload all these assets. The Federal Reserve balance sheet is going to explode because they're going to, increase their balance sheet. They're going to buy a bunch of assets, and so their balance sheet is going to get a lot bigger. But the problem is now all of these banks have just been flooded with trillions of dollars worth of new cash in the system. Banking 101 from earlier, what happens to cash that is in bank accounts? Well, it's held in reserves. Well, how do banks make money? They make money off of their reserves. They get a little bit of an interest rate on the reserves that they hold. They also loan it out, they buy equities, they buy treasuries, but a big portion of how they make money is reserves. And so if these trillions of dollars are created out of thin air, handed to the banks, they're just still gonna get crushed because they can't make enough money on the reserves because there's too much money in the banking system at that point. It still leaves the banks crushed. So the Federal Reserve and the Treasury say, all right, we've got it. Treasury, you will no longer have a bank account in the commercial banking system. We're going to remove your account from the commercial banking system, and now you're just going to have a separate account at the Fed. And Treasury says, fine, that's perfect, because that creates a little bit of a release valve, an escape valve for excess money. So the Federal Reserve and the Treasury, they got together and they did this. They said, okay, now the Treasury no longer has their account in the commercial banking system. You've got just a separate account at the Fed now. And you say, why does this help? Why does this matter? How does this help with eliminating excess reserves from the system? Well, let's take a look at this chart. If you take a look at this chart, you can see that right in 2008, it exploded the amount that is held at the Treasury General Account. Now, when you think about it, it makes sense because no longer is the Treasury General Account held in the commercial banking system, which means it's no longer contributing to keeping reserves in the reserves part of the commercial banking system. So post 2008, now every time the Treasury borrows money from a person in the economy, when somebody like you or I buy a Treasury, it actually sends money out of the banking system. Reserves are taken out of the banking system because it leaves my bank account, which is a part of the system, but it goes to the Treasury's account, which is no longer part of the system. And so in the 2008 financial crisis, they loaded up with a ton of debt. The Treasury loaded up with a ton of debt. That sucked a ton of money out of the banking system, out of the reserves. So it allowed the Federal Reserve and the Treasury to coordinate with each other and say, okay, I'm the Federal Reserve. I'm going to dump a ton of newly printed money into the economy. And I'm the Treasury, and so I'm going to soak up a lot of those new dollars that were created as to not allow all those excess dollars to crush the banks. And then when I need to, we can spend that into the economy. You can see here from 2008 over the next couple of years, it fluctuated then. It kind of peaks out at about $400 billion here, and then it gets spent down. Now, the opposite of this is true as well, and this is where it starts to get super interesting, because if the Treasury is accumulating excess dollars out of the system when it issues treasuries and when it collects taxes, because all of that money that goes to the Treasury now, that's not in the commercial banking system anymore. Remember, they have a separate account at the Fed now. So all of that money that they get from Treasury issuance and taxes comes out of the economy, comes out of the broad money supply. This means when they spend money, it goes back into the banking system. It goes back in to contribute to broad money supply, which goes back in to reserves in the banking system. Now, if you are familiar with quantitative easing at all, quantitative easing is kind of designed to increase reserves at banks. When banks get to unload assets and they get cash in return, that increases their reserves, it frees up balance sheet capacity to do things that stimulate the economy. They can buy stocks, they can loan again. And so quantitative easing, Federal Reserve doing QE, frees up balance sheet capacity at the banks, the primary dealers, to engage in financial activities. This is what stimulates the economy, and this is why they do QE, to try and push the economy forward. Now let's take a look at this chart one more time. Fast forward to today. What? The Treasury General Account is at almost $1.6 trillion. This is insane. Prior to the coronavirus happening, the previous record was $400 billion, and even that was a lot compared to what the Treasury General Account used to do before its bank account was removed from the commercial banking system. The Treasury General Account has blown up to about $1.6 trillion, which means that since the coronavirus happened, every dollar that the Federal Reserve has been doing in blowing up its balance sheet, about half of that has just gone into the Treasury General Account. So the QE has been successful in reinflating asset prices. It's taken assets off banks' balance sheets. It's allowed banks to engage in financial activities again and start buying stocks again and try and lend again. But the Federal Reserve's balance sheet has blown up by about $3 trillion. So if the Federal Reserve's balance sheet has increased by $3 trillion, that's $3 trillion that had to go somewhere. If we see over $1 trillion went to the Treasury General Account, where did the other $1.5 trillion go? Well, look at here. It went to the reserves. So the math adds up. About half the money of QE went into the reserve system, and about half of it has just built up at the Treasury General Account. So about half the effect of quantitative easing has hit the markets. The other half has not hit the markets. It has not hit the banking system. Half of the QE that the Federal Reserve has done in response to the coronavirus has built up a war chest, a bazooka at the Treasury that can be spent and launched at any time. I mean, look at this chart. We see here January 1st, 2017, pretty much right when Trump got into office, that Treasury General Account was unloaded. They spent it all. Well, what happened in 2017? there was a massive stock market rally with very little volatility. In case none of the mechanics of this make sense to you, that's totally fine. Here's the basics of what you need to know. Coronavirus panic happened, and so Congress launched a $3 trillion spending plan that was financed primarily by the Federal Reserve printing money. About close to a half of that money that they've printed is still loaded up at the Treasury General Account, and they can spend this whenever they want. We know that the other half of that money, it did make it into the economy, it did make it into reserves, and that did impact bank balance sheets, and we can see the result in what that's done to the stock market. But it is very possible that Trump is looking at this, and the Treasury is looking at this and saying, just in case we're going to need to do something to counteract, maybe the Federal Reserve is going to pull back on their easy money policy. Maybe they're going to try and raise rates. Who knows what they're going to do. It's possible the Treasury is looking at this as a trump card, pun intended, to say if we need to, we can double up on what has already hit the economy in terms of stimulus. We can write a $1 trillion check if we need to tomorrow. If they did that, that money gets spent into the economy. That's new money being introduced into the economy that wasn't there before. That goes to people's bank accounts, that goes to companies' bank accounts, that hits earnings, that hits revenues, that hits paychecks, that hits bonuses, that hits everything immediately. And there's a massive stimulus effect that would propel the stock market to the highest valuations, astronomical prices, an unbelievable, extraordinary bubble. But there's a catch. Classic Economics 101, price is dictated as a function of supply and demand. And so when you have a massive increase of money chasing the same amount of goods, it's not new goods that are being produced here. There's no actual stuff being made by writing a check. You just have new money hitting the wallets, hitting the bank accounts of all these businesses and people that can then go out and spend that in whatever way they want. But again, that new money didn't enter the system as a result of sales or business activity or growth. It was a blank check written by the United States government. And so you have a huge amount of money introduced into the system, exploding the amount of money, chasing the same amount of goods and services that was there before. Yes, that is a recipe for hyperinflation. Bottom line, you introduce new money into the system. First, it increases asset prices, then it increases prices of goods and services. If demand stays the same, people are still buying the same amount of stuff, but the supply decreases, that's going to increase prices. That's what happened as a result of the coronavirus. Lockdowns, businesses not producing anything anymore, supply chains breaking down, supply dropped, demand stayed the same, or in a lot of cases even rose because people were trying to hoard up on stuff. Prices skyrocket. The opposite is true as well. If supply stays the same and demand increases, that's going to make prices skyrocket. And so in the case of everybody receiving a blank check or companies receiving massive new contracts, let's say this $1.6 trillion is used to finance a Trump infrastructure plan. Very plausible. Pelosi and Trump have recently just come out saying, hey, we're going to try and push this brand new infrastructure plan. This is a plausible way to fund it. They've got $1.6 trillion in the war chest. Massive amounts of money going to all these contractors and companies. That's going to be an initial economic boom. But the fallout of that is hyperinflation, because you have massive amounts of money that are ejected into the system, chasing the same amount of goods and services. We've already seen how that started to happen, and this would only escalate that and accelerate that happening even faster. And the worst part is, this monetary policy and fiscal policy of inflationary financing things and spending money by creating money or injecting new money into the system, is what causes inequality. I've made videos about this before. You can go check out my inequality video. But inequality is caused by monetary expansion. The data proves that almost 100%. Since 1971, the trends started to reverse themselves on every measure of inequality, and they've only accelerated as time has gone on and as monetary policy has gotten more and more aggressive. And we know that inequality also contributes to violent crime. The reason for this is because cost of living goes up, which hurts the poor because they don't have assets. They can barely afford life as it is. Now life just got more expensive, and it benefits the rich because the rich are the ones that hold all the assets. They didn't need the extra money. They can afford afford to have an increase in cost of living because their assets going up in price are paying for it. And so monetary policy like this further accelerates the widening gap between the rich and the poor, which especially right now is not a recipe for success. But unfortunately, it is a recipe for re-election because the boom happens before the bust. Thank you so much for watching. If you enjoyed the video, I highly recommend again going and watching George Gammon's video on this same subject. He goes into a lot more detail on the mechanics of the banking system and how the assets and liabilities and the reserves work with the Treasury General Account, commercial banking system, and the Fed. It's a great video. Go check it out. He's got a great channel. Thank you so much for watching. If you enjoyed this video, please like, subscribe, share. You know the drill, helps the channel out, and I really appreciate you guys. Have a great day.